Welcome back to the channel. Thank you guys for subscribing and liking the videos and watching. Today we'll be speaking about premium and discount level. So in the market we have two levels, which is the premium and the discount. So the premium level, this is where we sell at the highest price, and then the discount level, this is where we buy at the lowest price. So premium level, we deal with sales, and discount level, this is where we deal with buys. So I'm gonna give you tools to help you to understand these two levels. So this is the market basically. Market went up and then came down and then went up. Right? So basically the market broke structure. We had a break of structure here, break of structure. So now we're looking for the market to come back to these areas, so that we buy from here going to the upward to the previous high. So understanding where we should buy, so as I just mentioned that we buy at a discount level. So when you look here on your right hand side, you can see that the highest price is around 703 200, and the lowest here is 696 400. So we are looking to buy at the very discounted area. So how do we get to know where to find our discounted area? So we use the Fibonacci retracement. This is our highest, and then we go to our lowest. So here on the Fibonacci retracement, here is our 50%, which is it's the red line that separates the 100%. The 100% is this green line, and here we have the 0%. So here on the 50% on our red line, this is where we get to cut the market into half. So technically inside here we have the inner range, and then outside of it we have the external range. So we're looking for price to come back to the external range to mitigate one of our 7 institutional reference points. So we are not going to be looking for our 7 institutional reference points around the 50%, okay, around the 70%, 80%, 60%, or on the 50%. This is not our point of interest. We are not going to be buying at this level. We're going to be buying way below, around our discounted area, which is the red box. So our discounted areas to buy at the lowest. So we'll be focusing around the 70% level to up to the 0% level around here. So In the external range, this is where we're going to be looking for our order block, fair value gap, mitigation block, breaker block, liquidity void, and our previous low and previous low. So when the market comes back to our external range, the market most of the time it comes here and then it traps traders all the time. So the market plays around the 50%, and then most traders think that the market has reacted to our institutional reference point, only for the market to go up and then go back down to mitigate and take out liquidity and then mitigate our safe institutional reference point. So what happens is that we get a lot of buyers coming in around here, and there'll be stop loss around here. People are placing stop loss, stop loss. So what happens is that now we have created liquidity here. So that means there's a lot of liquidity that's just sitting here. Then the market is going to pretend as if our it's going to our highest level, previous high here, but only for it to come back down. And what it does, it takes out the stop loss and the liquidity around these levels, takes them out, only for the market to come back to our institutional reference points. So on the discounted area. So anyway, besides our 70% to up to our 0%, we only look for our 7 institutional reference points here, your order block around this level, your fair value gap around this level, your breaker block, mitigation block, all of them around this level. So this is where we find our point of interest around this level, because the market has already would have taken out all the stop losses. So this is where we buy at the discounted level, just below the 50%. So when it comes to the premium level, which is the total opposite of what we just spoken about. So the price comes from the upside and then comes here, and then we have a breaker structure, premium. So we had a breaker structure here, breaker structure. So when it comes to selling, we sell at discounted level. Sorry, we sell at the premium level. Sorry. Um, so we use our Fibonacci retracement tool. So here we sell at a premium level. So the same thing that happens when we are buying and selling, that is that price will come here around the 50%, and then traders are gonna come in and they're gonna come in and sell, sell, and then so this represents the stop losses. So as soon as price looks like it's going to come to this level here, and then it changes direction, and then it goes to our premium level, which is here. And in the process, it takes out liquidity, and don't be a victim of that, like the inexperienced traders. So our premium level is above the 50% level, which is this red line here. It's above this red line, so we are looking to sell around the 70% way up to the 100% in the premium level. And what are we looking for? Which area are we looking for so that price can reverse here to continue going on the downside? Is we are looking for our 7 institutional reference points. Your order block will be sitting here on your premium level. Your fair value gap will be sitting here. Your mitigation block, breaker block, they'll be all sitting here. And of course, your previous high, which is around here, they'll be all sitting here. So this is where we will be selling at a premium level around these levels here. So we don't sell around here. So let's go to the market quickly and show you some quick examples. Voila, this one here. Okay, cool. Here we had the breaker structure. Okay, cool, whatever. So here we have a breaker structure, and then we take our Fibonacci tool from here. Take a Fibonacci tool from the highest to the lowest. So as you can see, is that price started from this level here, came here, went down here, and then it broke structure, and then it came down to our discounted level. And you know what discounted level, this is where we look for our institutional reference points, which is here we have the order block. So price reacted here on our order block, and then from the order block it went to our take profit, which is up here at a discounted level. Same thing as here, we had a breakout structure, price broke the structure, and then our Fibonacci tool so price from there it came here, and then second point, and then it broke our structure, and then now price is going into our external range. So inside our external range, price went straight to the discounted level, and from the discounted level it mitigated one of our institutional reference points, and it went to our take profit, back to our 100%. So the the where the price mitigated, we have our order block. So order block starts from here right up to here. This is our order block, and then we buy here at a discounted level. Stop loss a little bit below, and then I'll take profit at the previous high here. Voila. And then the same thing happened here. Here's the example I was telling you guys about what you should watch out for. Is that here we had a breakout structure, then price went to the upside, and we take our Fibonacci to the lowest, Fibonacci tool to the lowest. So this is what I was talking about. So now basically here we see the price after it broke structure, it came back to our external, coming to look for our 7 institutional reference point. So here price came to this level here. This is above the 70%, just a little bit below our 50%. So price came and reacted here, and then guess what? This is where unknowledgeable traders came in and started putting their buys here inside. So they bought, taking price up to the up top here, and then as you can see, the price from here it went up with them, and then guess what? It came back down to take them out. So you following what I'm saying, you wouldn't be a victim of this, because we don't buy, yeah, we don't buy price at a premium level, we buy price at a discounted level. So our discounted level is below our 50%, 70%, sorry, below our 40% right to our 0%. So our 0% is here, and what are we looking for here? We're looking for our institutional reference point. So the first one, we have an order block here. We have an order block here, order block, and As you can see, we don't have a fair value gap. Here we have a liquidity void. This is a liquidity void. So basically here at the liquidity void, we want the market to come and mitigate to fill up this so that it can come back down to our other institutional reference points. So as you can see, no, this is a rejection block. It's a rejection block. It's a rejection block. So as you can see, price came and it touched our rejection block. So you are in the good side buying from this level. Stop loss just a little bit below and then going to the upside. Look at that, like you'll be in good trades and you won't be the victim of liquidity grab. Sell. Okay, this one. So for selling, we sell at a premium level. Price went up and then price came down here. Okay, we don't have a breakout structure here. Actually, we do have a breakout structure because price broke this low. We have a breakout structure. We have a breakout structure. So price broke the structure and then we're looking for selling at a premium level. So this is how we do it. As you can see, here's another trap. So price went to 50%. Most traders also thought that price would be selling and then only to find out that price isn't done yet. And then it came down here. And then as soon as it got here, it came back up to take out the liquidity that was sitting here. So where our premium level is, which is right here, our premium level, which is right here, we start looking for our 7 institutional reference point. So the first one we have is the rejection block. It's here. Rejection block. And then number 2, what do we have? We have an order block, which is here. Order block. And then order block, it's blue. And then we have our fair value gap, all in the same area. Let's make it purple. Fair value gap. So price came here and then price broke structure, went down here, and then it went to our external range to come and mitigate our one of our 7 institutional reference points. So when it comes to this part is that we have 1, 2, 3, 3 of our institutional reference points all in the same area, so we have a PD array. Our point of interest is all here. So price went through our fair value gap to our order block, and then from there it reacted and then went to our take profit. So entry will be here. stop loss just above a rejection block. Then voila. Thank you guys for watching the video. Please like and subscribe. We'll be dropping more videos when it comes to Deriv synthetic indices to give you an edge when it comes to trading the synthetic indices. Thank you.